All right, you think we're ready, Tequila?
Absolutely, let's start.
All right. Well, good morning and welcome to today's webinar on repaying your student loans. We know that certainly as you've gone through your years of college and have incurred some loan debt, that certainly you want to make sure that you understand all of your rights and responsibilities as you go through the repayment. So today we're going to walk through some of those reminders to you as you go through your repayment period. Joining us today on the call with me is my colleague Tequila Barnes Hall. Tequila is the 336 CFNC regional representative. That's more so in the Triad area of the state. And I'm Amy Denton, the CFNC regional rep for the eastern part of the state, the 252 area code region. So we're grateful that you're here with us today, and we thank you for being a part of this. So let's go ahead and get started, and let's talk about some very basic information when it comes to student loans. First of all, you know the word loan simply means that the dollars have to be repaid, which is why we recommend, and as you hear often, that borrowing only what you need is recommended. So I hope you have done that as you've progressed through each of your years of college, whether it be undergraduate, grad school, whatever it may be, you have been able to borrow only what you absolutely needed to get through the cost of your college education. And other basic terms that you may hear us reference today is interest and capitalization of interest. That's what you're being charged for borrowing those dollars that are someone else's. So anytime you hear that, as you know, interest accrues on so many things, mortgages, car loans, everything. So that's what it means when you hear those words in the capitalization. It's money that's being charged to you because you're using someone else's dollars to acquire that education, so to say. Here are the different types of federal student loans. These are loans from the federal government, the Department of Education, which is considered direct loans. There are two primary types, Stafford loans, and there are two Stafford loans, the direct subsidized, and then there's also the direct unsubsidized. So let's talk about what the difference is between each of those. The subsidized loan is the loan based on your financial need. So when you file the FAFSA, you qualified to receive the need-based loan called the subsidized loan. While you're in college, no interest will have accrued on that loan as long as you were enrolled at least part-time. It is your debt because you assumed that loan while you're in college. You didn't have to go through a credit check, but you did have to sign a master promissory note. That's what we call your MPN, to make sure you understand all of your obligations of that loan while you're in college. And of course, as you go through the repayment period, that's what an MPN is. You may not remember signing it, but you did. The unsubsidized has many of the same characteristics, but it is a little bit differently. It is not based on need. So when you file the FAFSA and the college determined that you were eligible for the unsubsidized loan, it did not make a difference about the income and all those other dollars that were considered on your loan. You didn't qualify for the subsidized, but you still could receive the unsub. So it was not based on financial need. The interest accrues right away. So when you receive those dollars on your student account, interest began at that point. It is again just your student debt. You didn't have to go through a credit check, and you signed a master promissory note understanding all the obligations of those loans. Here are some other types of federal loans. Your parents could have borrowed what we call the Parent Plus loan for students. We call it the short PLUS, the parent loan for undergraduate students. This is your parents' debt. Your parents did have to go through a credit check. They signed a master promissory note understanding all of their obligations. It's not considered a need-based loan, so interest, just like that unsubsidized, started accruing just as soon as that loan hit your account. So quite often, parents borrow the PLUS loan because there still may be a balance that you owed to the institution. And those dollars were needed in the form of a loan because your parents needed to pay the bill, so to say. So again, the Parent Plus loan was your parents' debt and is not considered your debt. Graduate or professional loans. These are loans as you graduated with your bachelor's degree and you moved on to graduate school or maybe a higher level degree, you could have borrowed money. These are not considered need-based, but again, remember, just like the other loans we've talked about, you must have filed the FAFSA in order to receive these loans. You were a graduate student. Parents could borrow on behalf of you as long as you were dependent at that time and at least a half-time student. And of course, they've got to be repaid. All of these loans have to be repaid in some form or fashion. And again, you signed the master promissory note saying that you agreed to these loans. So those are the four primary types of federal loans: the direct unsubsidized, the direct subsidized, the direct parent loan, and then your graduate loans. Now, on top of the federal loans, a lot of companies are out there today. Just like us at College Foundation, we offer a private loan. There are private student loans, and we can also offer sometimes private parent loans. So these are loans that are considered alternative education loans. They are there to bridge the gap between any type of cost of your education and the amount of the money that the government gives you or the amount of financial aid that you've been given at the institution. So let's say that you did borrow federal loans, your student loans, maybe your parents borrowed loans and you had other financial assistance, but there was still a gap that you needed to pay the bills at your institution. So quite often, families do consider private student loans to fill in that gap to make the bills due. They're offered by private lenders, and there are no federal forms to complete. You do not go through the Department of Education for a private loan. You go through the company directly in which you're achieving the loan from. I just mentioned that we're one of those companies. We're one of those organizations that offer the NC Assist loan. We have this private loan in North Carolina to help students and families, parents, to get through that gap. It's available to any North Carolina resident and student who reside outside of North Carolina or certainly North Carolina, but are attending one of our institutions. Therefore, we call it the North Carolina Connection. As long as you are attending one of our institutions, whether you are a resident or a non-resident of our state, that makes students and families eligible for the NC Assist loan. Unlike some of the federal loans, we do not offer any application or origination or any prepayment fees. So let's say you wanted to go ahead and prepay your loan. You wanted to pay off the entire amount of your loan. Some other companies quite often, or the federal government may require any type of prepayment fees. But we're very fortunate that right now we do not offer any of those fees. We have somewhat of a competitive interest rate with our student interest rate. It's 5.5%. So when you borrow, we're going to offer you that loan at 5.5%. The good thing is when you go into a repayment period, we're going to be able to drop that interest rate by 0.25%, by 0.25%, as long as you're making auto draft repayments. So we can bring that loan down to 5.25% as long as you're maintaining auto draft. That means we're getting your money on a regular basis to repay your loan. No penalty to prepay. The balance of your loan, no penalty whatsoever. If this does by chance spark an interest in you, if you're planning to go further in your education, feel welcome to come out to our website at ncassist.org, and you'll see all the details, much more than what I've been able to share with you right here today about the NC Assist loan. And again, this is coming from College Foundation, and we are your state's nonprofit agency. So we're very reputable. We handle everything right there out of Raleigh. So feel welcome to share this with others too, as you may know that they need help bridging that gap to college. So let's talk about the dollar amounts for dependent students that you have been able to borrow, or you may continue to be able to borrow as you go through school. So let's talk about our undergraduate career field. The first couple of years that you've been in college, you're a dependent student, meaning you're dependent upon a parent. As a first-year undergraduate, whether that be your freshman year with freshman credit hours, you can qualify for a maximum of $3,500 in subsidized loans. Remember, that's the need-based loan. That's the loan that interest is not accruing as you're in college. Of course, it will begin to accrue when you go into a repayment, but while you're in school, there is no interest. You can qualify for an additional $2,000 in the unsub for a maximum your freshman year of $5,500. As you move on to your second year of undergraduate, that's typically your sophomore year, meaning you have sophomore credit hours at that institution. You can qualify for $4,500 in subsidized, an additional $2,000 in unsub, for a total of $6,500. And fortunately, as you move on to your third and fourth year of college, you can qualify for more money. You see the amounts there on the screen for a total of $7,500. The good news is, and quite often you hear this in the news and you hear family members and friends and so forth say that, you know, going to college and borrowing loans is not on their plate. We know that no one really wants to go into college thinking they have to borrow, but borrowing from the federal government is always the first route you want to take because number one, it's the federal government you're working with, it's lower interest rates, and they have tons of options when it comes to repayment. We're going to talk about those later today. And then lastly, you have caps. You have maximum amounts that you can borrow as an undergraduate student. And this is all the way for the government to prohibit students from coming out with large amounts of debt in loans when they graduate. So as you see there at the bottom, the limit for undergraduate students is $31,000 with no more than $23,000 in that subsidized, the need-based loan. And certainly you can borrow more than your cost of attendance, subtracting any of your financial aid. So sometimes if that's the case, you may see less than the annual maximum amounts being given to you. Okay? When it comes to independent students or dependent students whose parents were denied that parent loan, the PLUS loan, you can actually receive greater funding. So it's the same dollar amounts that we just talked about on the previous screen, but look over here in the unsubsidized amount column. Those dollars actually increase. So instead of the $2,000 that first-time student qualified for, because that parent was denied the Parent Plus loan, or now that they're independent, which means you have no relevance to your parents when it comes to receiving aid and filing the FAFSA, you can get another $4,000 more. So now that first-time student can get $9,500. And you see the rest of the loan amounts there. As your third and fourth year of college, that amount you can receive is an additional $5,000. So the dollar amounts do increase as you progress through each year of school, and certainly as you move on to graduate school. And you see the aggregate limits down at the bottom there. You can receive up to $57,000, just over that, as your total amount as an independent student, or a student whose parents were denied the PLUS loan. We've talked a little bit about that master promissory note. Let's look at what really that is and what does that mean for you. There's no way that you can go through your education, receiving a loan, not having signed the NPN. It is your rights and responsibilities. It's a binding legal document that you have signed up front to say, I understand the obligations that I'm getting into by borrowing this loan. And I understand that I have to repay this loan. That is my commitment to borrowing these dollars. And think of it this way too, when you're borrowing these dollars, depending upon your thoughts about having to use loans to get through your education, it's an investment to your future. It's an investment to your education that you're getting a good degree to hopefully go out to obtain a good career. And it's all well worth it, just like buying a car or buying a house. It's a commitment, it's an investment to what you're trying to achieve. And those things can get you further in life. So remember that this is truly a commitment and investment to your education by you signing the NPN. It can be used for only 1 year, or sometimes colleges can say that it can be a multi-year note. After so many years though, typically after 10 years, it will expire after you declare, or if you declare bankruptcy, or for any other reasons. Make sure you're checking with the servicer of your loan. And we're going to talk about what a loan servicer means coming up right soon. Where do you sign that master promissory note? Of course, your college would have directed you to the right place, but we'll share with you again too. It's studentaid.gov, or you can simply go to the new student aid, federal student aid website, the app, actually, My Student Aid. You can do it through or Apple or through Google or any other method of your phone. If you so wish, you can obtain the app to make sure that you're meeting this obligation of signing this NPN. You can't get the loan dollars without signing the NPN. So you have many ways to sign that particular note. Now, here's what we mean by a loan servicer. So when the college told you that you could borrow this loan if you so desired, you committed to borrowing the money by signing your NPN. At that point in time, you were assigned a loan servicer. For most of you, the dollars that you borrowed, if they were federal loans, they came from the Department of Ed. Previous loans from another loan program that we had, you would have been indeed assigned a lender or a loan servicer at that time. So these are the people that you communicate with to make sure you know all the rights and all the ins and outs as you progress through repayment. They're going to collect the repayment from you. They're going to monitor it. You should be notified by your loan servicer once it's dispersed to the school. If you have any questions about who your loan servicer is, you always contact your financial aid office. They'll have on record who that is. Even if you lose paperwork, you lose emails, you forget the name of that company, they're going to be able to tell you who that person is, who that company is that's providing the information to you about your loan. That's, again, called your loan servicer. Sometimes that loan servicer can transfer your loan. So what does that mean? Many different reasons why the company that had been servicing your loan will move your loan to another servicer. They can move it to another secondary market, or of course, move it to the Department of Ed. If you have an existing loan through one of our loan programs from way back in the day, they can move that loan. Now, the good news is the terms and conditions of that loan remain the same. So just because it's been transferred to another company, it'll pick back up with that new company the same way it was before. Nothing really changes. It's just a new name, a new company that's going to be servicing that loan for you. You will be provided with the new holder's company name, their address, their telephone number. And of course, they must notify you in writing of this change. So anytime you get this, if you have questions and you don't understand why your company is changing, you make sure you always contact your financial aid office to fully gather all the details to make sure you understand. The new company will be the company that therefore picks up your loan and who you pay back and who you will contact with any types of questions. Okay? So at this time, we're going to go into more details about the repayment on all the different variations of your loans. And my colleague, Tequila Hall, will pick up at this point to carry on for most of the rest of the presentation. Tequila?
All right. Thank you so much, Amy. So I want to talk a little bit about repayment, how that begins. So once you're going into repayment, you will have a 6-month grace period. So that begins once you graduate. So we're excited for those of you that might be attending that are graduating, or if at some point you just stop attending for whatever reason. So you're falling below half-time. So you've separated from your institution. So I just want to make sure that you know about that. And of course, your loan servicer will advise you of your first payment. So whatever that due date is. So just be on the lookout for that information. So it's very important that we're just helping you understand your rights and responsibilities, as well as what your repayment options are. So we're going to go over lots of different repayment options. So before I go into all of these, I just want you to know, once you do go into repayment, you're automatically, enrolled into what we call a standard repayment plan. So that's going to be the default. So unless you choose another payment plan, you will automatically be in what we call the standard repayment plan. So we're going to talk about those plans. So here's a summary of some of the repayment options we're going to talk about. So we're going to talk about repayment plan options like the standard. We're going to talk about graduate or graduated repayment, extended repayment, some income sensitive options that are available. And there are a couple different income-driven repayment plans. So we're going to talk about those as well. So we're going to talk about income contingent, income-based repayment, pay as you earn, just to give you an idea of what's coming up next. So let's just talk about that standard repayment plan. Here's some facts. So if you're going to stay with the default payment plan, that's the one that you're automatically, put in if you don't choose anything else. So for that one, the loan balance is calculated over 10 years. So you have 10 years to repay that loan. Now, I also want you to know there is never any prepayment penalties. So if you want to pay your loan off early, you can do that anytime. So the minimum monthly payment that you can, or the lowest monthly payment you can ever have is $50. Now, just depending on how much you borrow, that amount could be different. So what's going to happen under the standard repayment plan, your servicer is going to take whatever you borrowed and allow you to make equal payments for 10 years until that account has been paid off. So I just want to make sure that you're aware of that. Now let's talk about graduated repayment. So you can just imagine what that's all about. So graduated. So it really does mean exactly what it says. So payments are lower at first, and then they're going to get a little bit, higher over time. So usually every 2 years. So you'll pay more than the standard year plan that we just talked about. So, but you again have up to 10 years repay. And of course, there's no prepayment penalties. And remember, this is a payment plan type that you have to request from your servicer. Now, extended repayment. So payments may be fixed or graduated. And so you have up to 25 years to repay. Yeah, that's a long time, right? So just keep in mind that if you at any point want to pay it off early, you certainly can. So you must have more than $30,000 in outstanding debt. So, if you're trying to figure out what repayment option or plan might be best for you, now you're only looking at this one if you have at least $30,000 in outstanding loan debt. So you'll usually pay more than the standard 10-year plan. All right, now here's the other plans that I said that I was going to talk to you about. We're going to talk about income-based repayment. So in the world of financial aid, we use a lot of acronyms. So I don't expect for you to know all of these, but your servicer is going to know it. So we affectionately call this IBR. So payments will be either 10 or 15% of your discretionary income, but it's going to never be more than you would have paid under your standard repayment plan. So, as we talk about income-based repayment options, you're going to hear some of these things over and over again. So some of them are a little bit repetitive, but for this, payments are recalculated each year based upon your income and your family size. So keep that in mind when we start talking about income-based repayment options. Now, this is something I want to make sure that you understand, that any outstanding balance on your loan will be forgiven after 20 or 25 years. So that's going to be just depending on when you received your first loan. So want to make sure that you understand that. And again, you may pay more than the standard 10-year plan. Now, we just talked about income, based repayment. Now we're going to talk about income contingent repayment. So this one is ICR. So your monthly payments will be the lesser of either 20% of your discretionary income or the amount you pay on a repayment plan with a fixed plan over 12 years. So this is going to be adjusted, again, according to your income. So when you hear income, just know that something's going to be happening or adjusted based upon income. So again, you're going to see payments recalculated. And so this is going to be each year. Again, they're looking at your income, they're looking at your family size to make that determination. Now, if you have any outstanding, balance, it will be forgiven if you haven't repaid it in full after 25 years. Okay. So again, keep that in mind. So again, you'll pay more than the standard 10-year plan. Now we're going to talk a little bit about income sensitive repayment. So again, your monthly payment is based on your annual income. So again, like I said, anytime we're talking about income, you're going to know that's going to be a factor, okay? But your loan will be paid in full within 15 years. So again, you'll usually pay more than that standard 10-year plan. Now, this is only available if you had one of the older loans that my colleague talked about. So if it was under the Federal Family Education Loan Program. Now, here's some pretty interesting payment options that we're going to talk about. So I want to make sure that you understand this one because the next one is very similar. So we're going to talk about pay as you earn. So PAYE, pay as you earn. So your monthly payments will be 10% of your discretionary income. But of course, it's not going to be more than you would have paid under your 10-year standard repayment plan. So one of the criteria I want to make sure that you understand is you must have a high debt relative to your income to qualify. Now, again, payments are going to be recalculated each year. And again, we're looking at what? We're looking at your income as well as your family size. Now, if you have any outstanding balance on your loan,